You sat at your desk during open enrollment. You clicked the Roth option. You felt a little smug, honestly, because you'd done the reading. Tax-free in retirement. Future you was going to be very pleased with present you. Here's the thing nobody mentioned on that screen. If you've been doing that for years, your account almost certainly has a traditional pre-tax bucket inside it. You didn't pick it, your employer built it for you, quietly, every payday. And every dollar in that bucket comes with a tax bill attached. If you're a Roth 401k contributor, I keep seeing the same pattern. You think your account is one thing. It is structurally two things, and the half you didn't choose is the half the IRS is going to tax as ordinary income the day you withdraw it. I'd argue this is the single most misunderstood piece of retirement plumbing in the country. So let's actually look inside. In roughly 86% of Vanguard plans, the Roth 401k option is available. Most people who use it assume that means their whole account is Roth. It doesn't. The 401k system runs separate accounting for each tax bucket inside the same plan. Your contributions go in one bucket, your employer's match goes in another. They sit side by side, same statement, two completely different futures. Now the bigger question, why? For decades, the IRS required employer matching contributions to land in a pre-tax traditional account. Always, no exceptions. Didn't matter if you went 100% Roth on your own deferrals, the match still went pre-tax. The reason is actually pretty clean once you hear it. Employer contributions get deducted as a business expense. They've never been taxed on the employer side, so the IRS kept them in the pre-tax bucket so they'd be taxed exactly once on your way out. That's the whole mechanism, not malicious, just how the math worked. Then, on December 29, 2022, Congress signed the Secure 2.0 Act. Section 604, the part of the law that actually matters here, changed the rule for the first time. Employers can now designate matching contributions as Roth. The IRS followed up with Notice 2024-2 on December 20, 2023, laying out exactly how the mechanics work in practice. Sounds like the problem just solved itself, right? Quick aside, if you're not sure what your plan actually offers, drop in the comments which plan provider you're with. I keep a running list of which administrators have rolled out Roth matching and which haven't, and viewer answers help me update it. Here's the catch. Section 604 is optional. Your employer doesn't have to offer it, and there's a structural cost that has slowed adoption way down. Any matching dollars designated as Roth must be 100% vested immediately at the moment of allocation. They cannot sit on a vesting schedule. For a lot of employers, that's a meaningful financial commitment they weren't making before. You might be thinking, but Roth matching is going to spread fast, right? Maybe. The administrative complexity is real. Plan administrators are also racing to implement other Secure 2.0 provisions at the same time, including mandatory Roth catch-up rules. Roth matching adoption is, in industry shorthand, in early innings, which is a polite way of saying most plans still haven't done it. Which means the structure you've had for years is the structure you probably still have. You're a hybrid account. You just didn't know. Now let me put real numbers on this so you can see the stakes. And these are the actual 2026 numbers, not last year's, not next year's projections. The numbers you're looking at right now during open enrollment. The 401k contribution limit for 2026 is $24,500 for anyone under 50. If you're 50 or older, the catch-up bumps that to $32,500. And there's a new super catch-up if you're age 60 through 63 and your plan permits it, you can go up to $35,750 total this year. If you're a single filer with taxable income from $105,701 to $201,775, you're in the 24% federal marginal bracket. That's the bracket a lot of you watching right now sit in. And here's a counter thesis I want to dispatch directly. You may have been told the 24% bracket was about to revert higher in 2026. The One Big Beautiful Bill Act passed in July 2025 made most of those individual tax provisions permanent. The widely anticipated sunset did not happen, so 24% is now a stable planning input, not a ticking clock. Picture this. You earn $150,000 and your employer matches 5%. That's $7,500 per year landing in the traditional pre-tax bucket. Over 20 years, with growth, you're sitting on a substantial pre-tax balance you never explicitly opted into. When you pull it out in retirement, every dollar of it gets taxed as ordinary income. The Roth contributions you made, those are tax-free at qualified withdrawal, meaning the account's been open at least 5 years and you're at least 59 and a half. Two completely different tax treatments, same statement. Here's something almost no one mentions. The Roth 401k has no income limits, none. The The Roth IRA phases out for single filers between $146,000 and $161,000 of modified adjusted gross income. If you're above that, the Roth IRA door is closed to you. The Roth 401k door isn't. For a lot of higher earners, the Roth 401k is the only Roth tool you actually have. If you've ever felt that little flutter of wait, that's me reading any of this. The like button on this video is honestly how I figure out which of these structural plumbing breakdowns to make next. Now let's talk about why the pre-tax bucket your employer is filling matters more than you think well past retirement day. Required minimum distributions kick in at age 73 under current law. Once they start, you don't get to choose how much pre-tax money to pull. The IRS decides for you, based on the balance in the traditional bucket. For people who've built up large pre-tax balances over a 30 or 40-year career, RMDs can push them into a higher bracket than they'd planned for. It gets worse. Because RMDs count as ordinary income, they can trigger Social Security taxation. Single filers with combined income over $34,000 see up to 85% of their Social Security benefits become taxable. For married couples, that threshold is $44,000. RMDs drag you across those lines without asking. Then there's IRMAA, the income-related monthly adjustment amount. It uses a 2-year look-back on your modified adjusted gross income to set your Medicare premiums. The married couple threshold sits at $194,000 in modified adjusted gross income. Cross it, and your Medicare Part B and Part D premiums jump. RMDs plus other income can push a retiree over IRMAA thresholds they didn't see coming. Here's the counter to all of that. Qualified Roth withdrawals don't count toward modified adjusted gross income for these calculations. Roth dollars give you control over your taxable income in retirement in a way traditional dollars simply do not. You might be thinking RMDs aren't really an issue. There are mitigation strategies, conversions, charitable distributions. True. But every one of those strategies is more complicated and more expensive than just having Roth assets in the first place. There's one more dimension that flips the math for some viewers. If you live in one of the 9 states with no broad-based personal income tax, Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming, the calculus shifts. If you're earning in a high-tax state right now and plan to retire to a no-tax state, your pre-tax bucket gets a state tax break on the way out that the Roth bucket already paid for on the way in. For viewers in that situation, the traditional bucket your employer is building is actually working harder for you than it looks. So what do you actually do? This is what I'd want you to do this week before open enrollment closes. 3 things. First, capture the full employer match. Always. A dollar-for-dollar match is an immediate 100% return on that money. A 50-cent match is 50%. Walking away from that to prioritize anything else is one of the most expensive choices a saver can make. There's a counter-thesis that match isn't always the most important factor, that tax diversification or flexibility might matter more for some people. I take that argument seriously. It's almost never right. Capture the match, then make other decisions. Second, call HR or log into your plan portal. Ask one specific question. Has our plan adopted Roth matching under Secure 2.0 Section 604? If they say yes, you have the option to direct the match itself into your Roth bucket. If they say no, and most will, your match is still going pre-tax. That single answer should shape your whole contribution split. Third, reframe the question. The decision is not Roth or traditional in a vacuum. Your employer has already made part of that decision for you. The real question is, how much Roth do I want to layer on top of the traditional base my employer is already building? You might hear that a 50-50 split between Roth and traditional contributions is the right answer. It's a defensible hedge. It is not optimal for everyone. Your current bracket, your projected retirement bracket, your state, and your existing balances all change the answer. The 50-50 split is a starting point for the genuinely uncertain. It is not a recommendation. The viewer this video is for, the Roth 401k contributor who thought they had a single bucket account now knows the structure. 2 buckets, one you chose, one you got, and both serve you in retirement if you understand which is which. This is general education, not personalized advice. Before you change your contribution split or act on any of this, talk to a fee-only financial advisor or a CPA who knows your full situation. Your bracket, your state, your projected income, your spouse's plan if you're married. They can run numbers a video can't. If understanding the order you fund these accounts in is the next thing you want to nail down, there's a decision tree that determines whether you're going to retire on your terms or your boss's. And most people fund accounts in the wrong order without realizing it. That's the breakdown I'm doing next. I'll see you there.